He's doing well. And I just need to say that by participating in this webinar, it is being recorded and it will go on YouTube. So thank you very much. So I think we'll just get started now, and we welcome everybody to join us. So my name is Susan Aronson, and I direct the Digital Trade and Data Governance Hub at GW. And we are very pleased to have this webinar on the microeconomics of data. And so I'm going to pass it over to my colleague, Professor Ingo Borchert, who is a professor at the University of Sussex and also the Deputy Director of the UK Trade Policy Observatory. Ingo?
Thank you very much, Susan. And it's a great pleasure to be able to moderate that webinar, which I think is the 21st of the Hub this year. Is that right? It's almost a platitude, but it's actually true that data underpins virtually everything in the digital economy. And so it's vital that we understand the economic nature of data and its effects. And so it's spot on that the Hub has organized 2 webinars specifically dedicated to the economics of data. Today is the second event in that series. And as Susan said, we'll try to get at the bottom of the microeconomics of data. So how firms use data, how we can conceptualize data's contribution to economic output, and we'll ask how data then affect more aggregate outcomes, such firm dynamics, pricing, and productivity. So let me introduce our 2 speakers, both of whom are academics with deep knowledge on data and the role of data in the digital economy. Laura Veldkamp is a professor of finance at Columbia University's Graduate School of Business. Her background is in applied mathematics, and her research focuses on information processing at the micro level. That is how agents and firms, individuals, how they get their information and how information then affects their decisions. Laura is a co-editor of the Journal of Economic Theory, and she frequently advises the New York Fed and the Minneapolis Fed. So it strikes me as a rare combination of theoretical rigor and applied interest in applied work. David Nguyen is an economist at the OECD, at the OECD's Public Governance Directorate. He's previously been a senior economist at the National Institute of Economic and Social Research in London, and he studied measurement and valuation issues that crop up in the increasingly digital and intangible economy. So in a nutshell, exactly the 2 people that you would want for this kind of discussion. So welcome, Laura and David. Thank you for your time. As Hub webinars, the plan for today is that we start off with 2 or 3 rounds of questions for the speakers. And then we'll open it up to entertain audience questions, so which you can put to us via the Q&A function. And as we go along, please do keep the questions flowing, for we want this to be, as much a dialogue, as possible, really. Maybe I can start with you, Laura. Just, get us started, get some momentum, and really bring everyone on the same page. What's a data-driven economy? What's qualitatively new about it?
Thanks, Ingo. The data-driven economy is different in a few ways, right? If you think about what does a classical economy look like, we learned economics as we take some labor and we take some capital and we combine them to produce some widgets in a factory, right? And it really looks like a manufacturing economy. And so, what many of us are doing today is we're taking some labor, some effort, some time, and we're combining it with some data to produce some knowledge. So, in some ways we could say, well, data is the new capital, right? It's just replaced capital in that story about how things are produced. But there are a few things that are different about that data story. So the first thing is how data is produced, right? So much of data is a byproduct of economic activity, right? I don't invest in producing data in a test tube in a lab. Data gets produced when I go to Amazon and I go order some cereal and they find out what kind of cereal I like and where I live and how much I'm willing to pay for it. So it's a byproduct in a way that capital isn't really a byproduct of producing other things. It's also easily replicable, right? I can't replicate this widget producing factory at low marginal cost. I'd have to pay a lot of money to build it from the ground up, next door or somewhere else. Whereas data, I can easily just, copy it on a hard drive and send it off to somebody at a very low cost. So we can share it in different ways. And then, it may have different sorts of returns, right? Maybe capital, this is an ongoing debate, but this is a maybe. We tend to think of capital as having diminishing returns. That's sort of the essence of why poor countries can grow quickly and rich countries can grow slowly. The jury is still out on whether those similar properties apply to data. I argue that in some of my work that they do, but I think the truth is it depends a little bit on what we're doing with data. So we may or may not have the same kinds of slowdown in growth as we accumulate data, depending on what's done with it.
Excellent. Thank you very much, Laura, for setting the scene. And I'm sure we're going to come back to this and quiz you a little bit more on these elusive returns to data as a capital. David, would you like to add to this? How data is perhaps impactful from a more business perspective, which I think is something you've looked at very very carefully.
Yes, thanks, Ingo, and pleasure to be here. Good morning, good afternoon, good evening, everyone. I think I kind of often get asked like, what's the digital economy or what's the data economy, and I think there's probably there's probably an easy answer, which nowadays you probably say it's the economy, right? So to a large degree, it's very difficult to find a sector probably that's not been disrupted by data analytics or the data economy, digital technologies, and so on, which is also, I think, already one of the big problems that we're going to talk about today. It's just like how can we actually think about like different types of sectors if now we have companies operating across a range of them. I think the more complex answer really is then, and I really appreciate Laura going through all the different characteristics already of data, which are directly linked to the value that data has. I think that's really, really crucial here. And the more complex answer then probably is how data is then being used by businesses in order to generate new revenue models, for example, right? So you could use data to generate entirely new business models, which we see across the economy, obviously, especially with online platforms. Or you could use data and data analytics to enhance the business model you already have, so to generate new or better products based on your existing product line and so on. So I think kind of this enhancement or creation of new business models is for me what's crucial about the data economy. Just last point on this, I think what's new to what we had in the past, because obviously companies have been collecting data since always, probably to some degree, but now it's really, we talk about completely different volume and scale of how much data and the variety of data that's being collected. So I really think that's what's different nowadays.
Thank you very much, David. That's very useful. I would like to get into the valuation question, more deeply in a minute. But since you mentioned it, can I just stay with that distinction between data-enabled businesses and data-enhanced businesses, which you have been proposing? I think, is there a way of putting a number on it? Either as crudely perhaps as a count measure of firms, or as a share of the GDP, ambitiously perhaps. Is there any way of getting a metric of just how important that data-driven economy has been? Or if we don't, it would equally be interesting as a knowledge gap. Why don't we have that seemingly important statistic yet?
I absolutely agree with you. I think this is a crucial statistic that we should be producing at some point. I think there's a big knowledge gap here. I think conceptually we don't really understand yet what these different types of businesses, if you want, how they look like. So it's very difficult to measure them in practice. So the way we think about the data enhanced or data enabled models is really to the kind of share of revenue that a company, for example, is deriving based on data as an input to production in a very broad sense. We can then distinguish different types of data, but they could be selling data, they could be using data to generate a new service, for example, on top of an existing service, or they can just use data to basically overall enhance their business efficiency, just kind of increase the overall productivity of the business itself. So you can see there's different degrees to which companies can use data in different types of strategies. And so I think the short answer would be that we don't have those figures yet, but it's definitely a clear knowledge gap that we don't really know how many companies are pursuing which type of strategy.
Yeah, thank you, David. I mean, anyone working with micro level, firm level data, knows that this kind of information and revenue shares related to data, or it's just not available even in the best data sets in the world, which is a shame. Good. Let me sort of get into a first round of really sort of substantive questions to do with modeling and valuation. Really, Laura, you have thought long and deep about how one could possibly go about modeling data. You just said a minute ago it accrues as a byproduct to ordinary economic activity, perhaps. How have people? Can you give us a short overview? How have people gone about modeling data, and what do we learn from that in terms of what data's contribution really is to producing economic output?
So some people think about modeling data as it's like more ideas or better technology. I don't think that's the right way to think about it. I think it makes more sense to think about data as information, and it's information we're using to forecast some unknown outcome in many cases. So that unknown outcome, sometimes in research we use data to try to, to advance new ideas. But oftentimes businesses are using it to do things like forecast what demand will be, so I can have the right, products in inventory, or figure out how I should load the trucks more efficiently to get transportation, as cost effective as to transport things as cost effectively as possible. Or they're trying to figure out, how to evaluate workers and how to compensate them to incentivize hard work. And so a lot of these are prediction problems. That's not everything that's done with data, but that's a large part of what ordinary firms. This is probably more of the data enhanced business model than the data enabled business model that David was talking about. I like that distinction. So when we think about modeling data enhanced businesses, we often think about this as information, and it's being used to forecast some uncertain outcome, like how hard a worker will work, or how many 6 packs of beer a consumer will buy on the 4th of July weekend, right? And in doing that, that allows that firm to allocate resources more effectively. So it's very much like a portfolio problem of where do I want to, for a firm saying, where do I want to put my money? Much like an investor might say, where do I want to put my savings, and in which risky assets? Well, firms are also making resource allocation decisions about what sorts of risky activities, and that risky activity may be stocking a lot of Miller Lite, hoping that that's going to be a really popular beer in this neighborhood, in this supermarket, or deciding that something else is likely to be higher revenue. So we're thinking about it much like many problems in finance, where there are different risks one might take, and they're using information to help them assess those risks.
Thank you, Laura. Maybe we'll stay at that point just for a minute, because you in one of the models that you'd been suggesting, firms would produce, because that production, as you said, generates data as a byproduct, and that then increases the firm's prediction or forecast and so on. But that does sound a lot like an investment to me, and I think you were just alluding to optimal decisions yourself. So that there must be an optimization going on, and so if that was true, wouldn't that lend itself to sort of a shadow price for new data? And that seems to get us closer to that holy grail of how can we value data? Is that something where you can make your model useful, or that could speak to that point of the value, marginal value of data?
Absolutely. I think one of the challenges that we as economists are facing, and that we've alluded to already in this conversation, is we don't have good measures of data, right? Well, why don't we have good measures? Well, it's not obvious how to measure data, right? Do we go along counting bits? You've got this many terabits and I've got this many gigabytes, so your bits are bigger than my bits, so they must be worth more. Well, I don't know. It depends on what your data is about, right? Maybe your data is not very relevant, or maybe it's outdated. Maybe it's from a year ago and the world has changed. And so how do we measure this? Well, that is a modeling question, right? We need structures to inform us about what should we be looking at and how should we take the set of things we observe in the world and map them into a value. And so that's the goal of a lot of these theories right now. It's telling stories about what's going on. So mathematics embody a narrative, but they're also about, if that's what we think is going on, then what should we look to and how should we take the things we observe in the world to make some inference? And you're right, that firms are producing, many famous firms are producing at a loss early on in there. I think Amazon produced for something like 28 quarters before they ever made a profit. And why? Were they crazy? Well, no, not at all, right? They've been enormously successful, but what were they doing? They were investing. They were investing by producing a lot or selling a lot, in this case, doing lots of transactions of very low margins in order to build up a customer database. And so I do think we should think of production now, especially low cost production that's data intensive, as a form of investment.
Yeah, thanks, Laura. And I think that's quite closely related to the first question that we got. Let me just read it out for the benefit of everyone. At the aggregate level, is data a factor of production? And is it gathered from individual personal data? I guess not necessarily. Perhaps you could gather sensor data or all kinds of data. And how is it remunerated? Apart from the remuneration part of the question, we would, if data was an ordinary factor of production, I think we would, our 101 question would be to pay its marginal product. Now, data are rife with externalities. So why does it not work? Why can't we establish a marginal value of data, or can we? I mean, both of you, David, feel free to chip in.
You want me to start, or do you want? Okay.
Yeah, whilst you're in full swing, Laura, why don't you just continue?
Sure.
David to comment.
Okay, so I mean, data clearly has a marginal product. It's not easy to assess what it is, right? So one thing we could do is, we could ask firms to run an experiment. Take some of your data and lock it away and don't use it. See how you do. Put it back and see how you do, right? And we could try. I don't know who would agree with this, but that would be one way to get at a marginal product. Another way to get at a marginal product is to ask, well, how much is a firm willing to pay somebody to gather and accumulate this data? So one evidence we have of how much data firms are getting and how they value it is how they're hiring data workers in labor markets, right? They can keep lots of things secret, but if they want to hire workers, it kind of has to be out there in the open. So labor markets are really good as providing footprints, evidence of what's going on. And so, one thing we can do is go look at hiring of database managers, right? You can't use data if it's not well organized and well in a clear, coherent data system. And those are jobs for people. And so how many of them are hiring, and how much are we paying them? And how much we pay them also reveals something about what's the marginal value, at least what does the firm perceive about the marginal value of its own data? How much are they willing to pay that last marginal data manager who helps collect and organize all this data? So you can look at the revenue stream, you can look at the costs being incurred and the choices that firms are making. And my guess is we'll be using both of these tools as we go forward to try to make inference about what this value might be.
Yes, thank you, Laura. Absolutely. And when it comes to sort of monetizing, money, you were alluding to Amazon's customer database. I think, that database becomes ever more valuable the more customers you add to it. There seems to be an issue of rather, network externalities or increasing returns rather. I mean, David, if you want to come in on any of this, or rather on the second question, which is about the role of different kinds of data, in particular, the distinction between data and metadata, and their respective role in monetizing metadata, then please feel free.
Yeah, thanks. I mean, I really like that modeling approach that Laura was just outlining to all of us, and I think there might be important to kind of distinguish two additional concepts here. And I think one is there's different types of data. So obviously, it really matters who's the subject of the data, who has access to it. Is it personal, non-personal? Like, there's many different types of data, and since data has been called so many things, I think it's really important to think about it also that there's just different types, and that's clearly associated with value. And the second thing is that data can have different characteristics within the same type of data. So, we can think about more classic things like, is it linkable? Is it this? Can we disaggregate the data? Can we? Is it timely? Do we actually trust the data or not? So I think there's many different characteristics, and we discussed that in the paper with my co-author Marta Pachos, that that's clearly and directly linked to how we can model data than in any kind of valuation. I mean, let me give you one example, and I think this links to the marginal product in a way that I think that there's threshold effects here, right? So you probably having data on 100 social media users or 100 kilometers of road driving of self-driving cars is probably not that valuable, but there will be a point when it's extremely valuable, and that point might not be known to the company yet, or whoever is collecting the data and then selling it. So I think there's threshold effects which make it very, very difficult. And probably there's also at some point diminishing returns, in the sense that, if we stick with the self-driving car example, probably after 100,000 miles of driving on the highway, an additional mile of highway driving is probably not too useful, but having data on specific situations of driving within cities is extremely valuable data on like rare situations and so on. And we see that with a lot of problems within the models of self-driving cars, that it's just matters that the quality of data that you have, because a lot of the data will still be hand labeled, even though it's used by machine learning algorithms. So there's some issues here.
Thank you very much, David. So you seem to be you seem to be siding with the idea that there are diminishing returns to data and data usage at some point. The question is when that would be. Which brings me to the next point, because it takes off that observation that data are non-rivalous. They can be easily replicated, as Laura said a minute ago, but they're also obviously non-rivalous in consumption. And so that would mean that the more, everything else equal, the more you share it, the more you can sort of maximize the gains. And that, the flip side of that is that, firms would grow larger and larger as they use data, or they might potentially even want to merge in order to pool their data resources. That would be, data seeking mergers is one strategy that I think we observe in the real world. Can we say something? I think that gets us, slowly into the second realm of macroeconomic outcomes. Can we say something about the impact of the proliferation of data and data usage to firm dynamics? Do we think that's one factor behind quite distinct changes in the size distribution of firms? And if I were to name it, an oligopolization, really. With Laura. So.
Yeah, absolutely. So I think, David described in some ways the key underlying forces really nicely, that there's probably a region of increasing returns, right? Where if you've got data on 100 kilometers of road, what do you do with that, right? Or 100 customers. So, an additional data point at that point is worth very little. But once you've got enough of it, more data is worth more. And then you've got decreasing returns. Well, what does that mean for the firm dynamics? That means that you're going to have a really hard time if you're a small firm, because what does increasing returns mean? It means the returns are high when you've got more of it, but that means the returns are really low when you're small. So what this means practically for firms is it's really hard to grow from a small to a medium-sized firm. But once you get big enough, then you've got lots of data coming in, lots more transactions, you can sort of explode into a big firm. And so it suggests that there ought to be a missing middle of firms, and that's exactly what we're seeing. We're seeing there are a bunch of small firms out there that are data users. They're not trying to be big generators of data, but they're buying data from other firms to operate efficiently. And then you've got some really large firms out there, the Googles, Apples, and Amazons of the world that are generating lots and lots of data and thriving. Now, the question I think is, we can look at that and say, well, that's horrible, right? We shouldn't have lots of large firms. And traditionally, market competition and regulatory authorities have looked at that with a lot of suspicion and distrust, because there was no good reason for lots of the widget producing factories to be so large. If they were that large, they were probably reaping monopoly rents. But there is a good reason now why firms should be large, which is there are these economies of scale that Google generating lots and lots of data, collecting lots and lots of data, selling it to people is helping firms operate more efficiently. It's helping the people who produce, purple shoelaces find people who want to buy purple shoelaces. And that wasn't such an easy matching problem before. And, you might have had purple shoelace lovers who were just unsatisfied that they couldn't find that, right? So there are all kinds of these interesting products that we can find now that, speak to us and our particular desires that we can get at fairly low cost because they don't have to incur tons and tons of costs. So there are lots of benefits to the consumer of this. Now, I don't mean that to say we should be complacent about it and it's all okay. But I do think, one of the things we should recognize as we think about, firm dynamics is it may not be all bad to have, some large firms producing lots of data for the economy that help firms operate efficiently. There's a benefit and a cost here.
Yeah, so I think that echoes one of the questions that we got, which is could we say something about the increasing role of data stewards and data governance? We can, I think based on what you just said, Laura, I think we can understand that there are, as compared to a traditional economy, there are gains to larger firms and in a slightly skewed firm distribution. But I think there, as Susan Aronson, put it very nicely, there's a huge information asymmetry, in these data markets. And whilst it's true that, Google, Amazon, and the really big guys in that market assemble ever more troughs of data, the conditions under which other agents can access these data, it's not quite clear to me. I mean, is it, shall I say provocatively, is that sort of ideal, or should we think about that?
Yeah, I mean, maybe this is sort of like a utility problem, right? We didn't want 3 different companies all putting up electricity wires to compete with each other to provide electricity to everybody's home. It would just be a mess, right? It'd be hugely costly to society to put up all that infrastructure. So that was another example, or telephones or whatever, that you had big returns to scale. I guess old-fashioned telephones when we needed lots of physical infrastructure, not today's modern cell phones. That's a different ballgame. But what did we do? We nationalized them and regulated them, heavily. So maybe the model is to allow data companies to be really big, but think of them kind of like utilities. I'm not sure about that. That may stifle a lot of competition or a lot of innovation and a lot of incentives for innovation. But it is one way. There are similarities between electricity companies and data companies.
Yeah, and I think there is anecdotal evidence of researchers, sort of innocent academics, as it were, who try to get access to some of these data, be it from eBay or Amazon or Twitter or so on, for probably the most innocuous of all reasons for research, and I think it proves very difficult, to say the least. And it's certainly non-verifiable of whatever you get. David, slightly, moving from the firm dynamics to the product dynamics, there's something that you have nicely called a trend to rent and bundle, right? So, back in the old days, and I'm thinking of an operating system here, you put some cash on the table, you got a CD-ROM, and that was that. And these days, your operating system is much rather a continuous stream of updates, which I think allows the provider to collect all sorts of information along the way. Is there an incentive of these firms who produce together data to actually tweak their data and products in a way that generates ever more data? Is that the case? And if that was so, is it a problem in some sense?
Thanks, Ingo. I think there's a lot of issues in that question. I mean, I think part of the problem in a way is that the marginal cost of just serving one additional consumer is close to 0, right? So that's why we have large companies can easily expand to entirely new markets and countries overnight, virtually just buying very cheap cloud computing services and then just rolling out the services. So I think that's one way where of course we could have one company that's serving us hotel bookings for the entire world, everybody living here. I mean, sure, probably it would work, right? But I think, as Laura said, I would be worried in the long term about the impact on innovation to some degree that might be stifled also in that way. I think on the renting versus and renting and bundling, so I think that's something I hinted at in the very beginning. The problem is that a lot of stuff which we used to buy, so think about a CD or a cassette or something like that, that's a product, we can count it, it's in GDP, and it's very easy in a way. Nowadays you buy a subscription on a monthly basis, and then based on that you can have access to virtually all the music in the world, and that's constantly being updated as well. So I think that if you pay at all, right, there's a whole freemium business models where actually you might not even pay, but you're being served ads, and that's a whole nother issue. But let's assume that you pay for it, then if you compare that to the money we used to spend on physical music or videos or something, because obviously it's a fraction, and especially if you compare that to the quality that you get and to the kind of the catalog you have, if you want, the range of products or the variety. So I think the issue then becomes is how do we capture that from a consumer point of view, right? So the consumer value might be massive, right? And it clearly is. There's studies being shown. I can talk about one that we've been doing that shows that the consumer value is really, really large. The problem is we might not be able to capture a lot of it in our traditional statistics on productivity or GDP per capita and so on. So we've been arguing that there's probably an increasing wedge between the two, right? So it might not be bad for consumers, but it might look bad on paper if you want, right? And it might still be bad for some subgroups. But one thing we've been doing, for example, is we use the concept of willingness to accept. So kind of asking people through surveys, through contingent valuation surveys, to kind of ask how much we would have to pay them in order to give up access to certain digital goods for a certain period of time, right? And that's one way of getting to goods which are priced at zero in the market, right? So now we're getting a bit away from the bundling, but in that sense, that's really it, right? I'm providing you a service that you don't pay for. So in a way, we all know that if you're not paying for something, then you're the product. So since we're paying with our attention, that links back to data, right? So the more time you spend on a specific platform, the more data can be generated. So time spent on platform equals value of data, which can be captured in a way through contingent valuation and willingness to accept loss of access, in a nutshell.
Thank you, David. No, that's absolutely fascinating, and it's fine if we move away a little bit from the bundling, because I think we haven't talked a lot as yet about the valuation and the prevalence of these zero price, as it were, product or service. I would imagine you get fairly different answers, if you ask the children or the parents, if you abstain from some of these platforms. So, which is a funny way of the more serious question of framing and so on. I think you might get wildly different answers in the way how you try to elicit these willingness to pay or willingness to accept. Is there a way of scaling this up to? I can see this for individual products. Right? What is your willingness to accept? A day off, I don't know, social media or whatever. Are there pathways to tackling or solving, as it were, more generally, the increasing prevalence of intangibles and zero price goods in the economy, that we just get a better measurement?
I think the intangible concept that you mentioned there is actually crucial, both because the statistical systems or measurement systems as they were set up really came out of efforts to fund wars in a way, right? How can we estimate the tax base in terms of how many machines do we have, how many people work in which place, and so on, and that's easy to adapt in a way. But as Laura said all the way in the beginning, this is not now a knowledge-based economy, right? This is about information and how information is being used to generate value. And it's really difficult, not just conceptually, but also from a measurement point of view, to capture that. So there's people like Eric Brynjolfsson and his colleagues have done experiments where they ask people to give up access, but actually they would compensate them with money if they actually do not access. I think that's very interesting, and that kind of demonstrate that these methods work. In terms of scalability, probably not so much, right? So if you want to do that at a large scale for a large number of products that are constantly evolving over time, then we probably need some large scale surveys which can ask people to what their value is of certain types of goods that are ever changing over time. So I think that there's probably some way that we can scale these up, and we're doing currently some work with that with my co-author Diane Coyle in Cambridge.
I'll add to that, but I think it's much easier for people to have a grip on what their benefits are than what their costs are, right? So, if you say, how much, do you have to pay me to stay off, Facebook for a week? I might not know exactly, but I can sort of, ballpark a dollar amount. For me, it's not that much, but, for other people, it might be a lot. But if you say, what's the cost to me of Facebook collecting information on, which news stories that I click on? Well, I don't really have a good sense of that because I don't know what they're going to do with that data. I don't know what they're going to do with it immediately. And I don't know what they're going to do with it in the future and how they might use it to, price goods differently, for me, or target me with political ads that would, manipulate my emotions to get me to vote a particular way, or, any other even, nefarious things that I can't even conceive of now. I think I'd have a really hard time coming up with a price on all those potential uses of, downside uses of my data.
What David was just alluding to, one rationale, not the only one, but one rationale, for these zero price services is, I think what Dennis Snower and Paul Twomey have called this third party, barter trade, where, that information is collected, but it's being monetized sort of in a triangular way, the other way round. Is there sort of another rationale, Laura, from a more modeling point of view, why these incentives to data accumulation that you were alluding to, is that another sort of rationale for why we see these zero price goods and services? And can we sort of use that to, in the future returns, to value it? Sorry for belaboring the point, but in the end, as economists, right, we want to, the holy grail is to value all of this, no?
Absolutely. Okay, so I do think the fact that we don't know how to think through costs it makes us more susceptible to purchase these zero price goods, because, hey, it means I don't have to think about, what price am I going to pay? It's free. Sure, I'll take it. So I think there's a little bit of a behavioral element here where, as long as there isn't a monetary price, it gives us an excuse not to think through what some of the other costs might be. But if you ask me to pay, $1.99, that's not a very high price. But all of a sudden I start thinking about, well, what is the benefit of this and what is the cost? And then it triggers some of these thoughts about things that might be done with my data that are not so pleasant. So I do think that zero price is a way of getting around some of these ideas. Now, how do you value that thing that's at zero price? That's going to be difficult. So you could start asking people how much, doing surveys like what David was alluding to, how much would you, be willing to receive to give up this, this service? Or you could look at the firm's valuation. You could say, how does the stock market value this firm that maybe has very little intangible assets, but is mostly, a data harvesting and reselling firm, right? We could look at its market cap, or we could start using tools that are more similar to how we value physical capital. That's also a very difficult measurement problem, right? The building that I work in, that Columbia Business School owns, has never traded on the market. It was built by Columbia. It's been owned by Columbia. We know its cost maybe, but we have no idea what its current market value is exactly. We can sort of compare it to other things in the neighborhood, but really there's no other building that's anywhere near similar to it and anywhere near around its neighborhood that's ever, been bought or sold. So, we've developed the system of making inferences about the value of capital that we now, come to accept, but wasn't, nearly so obvious when we started doing it. So maybe we'll do something similar with data over time, is that we'll learn to figure out what are the important attributes of data sets and what are some transactions that have gone on with data and how can we use those to impute what the value of this data is.
Yes, I think that, thank you, Laura. I think that's a great segue to one of the questions. And I think that's one for David, because I think he has looked into the insurance market for data So the question is, are there data on what firms are paying to protect data against cyber attacks? And I guess any kind of data breaches or security breaches at large. Do we know anything, David?
I think it would be an overstatement to say I've looked into it, but it's one of the, I think it's one of the avenues we explore in one of the overview papers. So we kind of say, data breaches we know from surveys and from reports and so on that they're massively costly to companies, right? Or to any kind of organization, right? Could be a public sector organization too. They could be costly because they have cost for reputation, for like direct compensation to consumers, etc. So surely companies will want to insure themselves against it. So somewhere out there must be a model within insurance companies to figure out how much they would charge based on the potential damage that will be done if that data that a company holds would be released. But I mean, I'm pretty sure these models are proprietary. So I mean, it would be interesting to work maybe with the insurance market, some people that do these types of calculations to get maybe to how they think about the value of data. It's probably one aspect of data only. They look at kind of what's the kind of downside of or the externality, negative externality if that data will be in the public domain, etc. But I think it would definitely be interesting to look into that.
Thank you very much, David. Clearly there's a lot of know-how. The specialists who know exactly how to price something, probably being hired by the insurance company, as Laura said earlier, right? It's worthwhile observing the labor market. So all that know-how, might sit in these firms. So that kind of conversation might prove fruitful. We've got another question that sort of harks back to the dynamics of the firm size distribution, which is, some insights about large firms versus small firms dynamics, which entrenches the position of smaller firms at low levels of the data value chain. How can small firms move higher up the data value chain? I don't know, maybe, can I suggest that David makes a first start at this, because I know he has thought about the concept of a data value chain, and then Laura, you feel free to add.
I was hoping you're passing this one to Laura, but okay. No. I think so. I think the data value chain in a way is simply data's being collected, it's being stored, it's being aggregated, it's being analyzed, and then in the end it's being used in order to generate revenue, right? And that revenue generation activity might even create further data, as you were hinting at. So that it's actually a cycle in a way. It's not just a value chain. But you can see it involves a lot of stages and a lot of different technologies and expertise. So I think while there's been suggestions that obviously that digital technologies, that there's a certain J curve, right? So there's a certain investment you take, and once they diffuse to the economy and even the smallest firms can start implementing these technologies, then they will also increase their productivity. I think that there's some merit in that argument, because if you look at what it takes in terms of costs and expertise to use data analytics at the firm level, both are decreasing. So the expertise needed in a way. So through cloud services nowadays, if you go to any of the big providers on the website, they will have kind of ready tools on the shelf. You can just click and buy machine learning tools, and they're very easy to understand for non-specialists. So I think as we develop these technologies further, it's going to be easier for firms across the distribution that might not have the specialist data scientists in-house still use some sort of data analytics tool down the line at some point. That's probably the optimistic view on the whole thing, right? The pessimistic view would be that at some point large firms will serve us everything from A to Z, and I think there's a danger of that as well, obviously.
I guess I'll just add, for a small firm, find something really unusual, right? The key is to distinguish oneself with data that's very different in its nature, or maybe about some risks that are very different from most of the data out there. How one does that, I don't know, but the key is that you wanna be as different as possible from the existing data sources out there. And then I guess the other one that comes to mind, where is there still a ton of value to be generated through use of data? And I have to mention medicine, right? think of a laggard in terms of adopting data and adopting machine learning tools to provide really high value recommendations, right? Tons of medicine is a forecasting problem. What are the odds that you get this? What are the odds that this treatment helps you? And, they've, I understand a lot of this is regulatory, but to the extent that anybody can create a business model by resolving some of the problems that are keeping us from using data efficiently in medicine, that seems to be a really high value target.
Absolutely. Thank you, Laura. And perhaps that's, excuse me, that's one opportunity of picking up again an earlier question about novel approaches to monetize different types of data, in particular metadata as opposed to raw data. Is there anything, might not be, but is there anything that you want to add in terms of the different types of data we haven't yet talked as much about? There's public data, there's private data, proprietary, open data, and maybe as firms use data, they might establish sort of property rights over it that then morphs the data that might have been open or public beforehand into something money-making machine that is all of a sudden proprietary. Any thoughts along those lines?
Yeah, I mean, I don't know exactly what the kind of question is in terms of metadata, but in a way, data is basically a digitized observation of the real world, right? So you have let's say you have a very long list of observations that kind of comprises your raw data, if you want. There's probably not much value in that per se, right? So in a way, you first have to start aggregating that by certain characteristics that you're interested in, and to analyze it in that way to kind of find some averages or common data points that you're interested. So for me, that's the way how I would probably see metadata, but I might be wrong. But in a way, the value really arises when data is being aggregated to show you something that you can learn about the raw data. Because looking at raw data, as we economists probably know, it doesn't tell you much. But what's really interesting then, and the value comes out when you start aggregating it in a way.
Okay, well, unless Laura, wants to add something to that, I think there's one aspect in the question that we haven't yet come around to, and it actually combines, two questions from the same person. One that gets to the remuneration of the data usage. So data are being used, some of which might be personal data, not necessarily perhaps, but some. And then the question is, how is it being remunerated? It could be wages, it could be profits, it could be rents. And the follow-up question in that, realm that I think gets us a bit into the area of distribution and distributional impacts really of data usage is, does this then raise an issue of clarifying attribution of property rights to data, I would assume. Any takers for that one?
I'll say that one of the ways in which we're compensated for our data is sometimes a lot of data is being used to solve a matching problem. And so, am I willing to let Netflix learn about my movie preferences? Well, actually I am, because I value getting good recommendations for other films that I might like and that I have not yet seen. So there's some amount of efficiency payback being given to consumers. Does that fully compensate the consumer for all the uses now and in the future of their data? Probably not, hard to assess. There are particular cases where consumers are actually being given, financial rebates for the use of their data. So one that came to mind is if you go in the US, you go to a Whole Foods store and you let them scan a QR code that links your purchase to your Amazon Prime account, you will get a percentage off of your grocery order. And that was interesting to me because it seemed like the clearest example I'd seen yet of actually paying me. There was a clear dollar amount. You will save this much if you pull up this code on your phone. And it was clear that they were going to link, this order to my accounts and my previous orders on Amazon. So maybe we'll see more of activities like that. But then, could even I, as an economist who studies data, figure out whether this was a good deal? No, I took the 250, let them scan my QR code and went on with my day. And I probably got robbed by, that was too hard a problem for me to stand there at the front of the checkout line and try to work through and figure out at the moment. So, we see some sorts of compensation, but, again, I think it's really hard to know whether that's enough. If consumers had ownership rights over their data, we might have a little more incentive to sit down one day and try to figure it out. This might be the kind of decision making that you make like a mortgage. That's also a really hard problem to figure out which one to take, the fix, the flex. But these are decisions that we do a few times. Maybe we delegate our data management to somebody who does have a good algorithm to figure out what it's worth and gets us good deals for the use of our data and so forth. So, I think, I guess my reaction to this is that one of the challenges is this is a super hard problem to figure out how to compensate for. But maybe that means that we're going to delegate it, just like we might give our, retirement savings to a mutual fund manager these days. Maybe in the future, we're going to give our data, savings and rights to a data manager to manage for us, because it's just too hard a problem to solve at the front of the checkout line.
Yeah, I think it's one of the. Thank you very much, Laura. I mean, I think it's one of these questions where it's unavoidable to talk about governance, and how you would go about this. I mean, the primary sort of goal of that conversation here is to understand the economics, the microeconomics of data, but I think we can't eschew policy altogether. In a webinar that I was moderating last week, and we were told that there's a Latin American country where the consumer gets a rebate in the pharmacy if he or she agrees to the use of the personal data, then you get a 10 or 15% at the pharmacy. And because that is health data, I think we are in a whole different world here when it comes to the need for governance. David, do you want to add anything?
Yeah, maybe just one point on. I think as consumers, we probably, first of all, don't have a good idea of how much our data is worth, and second, we probably massively overvalue or overestimate in terms of how much our data is worth, right? So I mean, if let's say my social media data is probably not worth very much because there's a lot of people like me on social media, so for the company, they can figure out everything about me without me being there, and I think that's part of the issue. That probably, I mean, there have been all kinds of estimates that probably someone's personal data on social media is worth a couple of cents or dollars or whatever it is, and would you rather have a dollar versus them not having? It doesn't really matter at the individual level. So this becomes necessarily in a way an aggregate problem. The other thing is that we might not be compensated with monetary amounts directly, but obviously you don't have to be on Facebook, right? In a way that even at a zero price, a lot of people are choosing not to be there. So there must be some value for those people that choose to consume at a price of zero. That makes this a positive sum for them in a way. So I think the compensation might actually come in the service that you're getting. So that's why I kind of pushing it at this point. And I think valuing how much free is worth actually gets us some way towards like valuing how much data is worth, not just to the business, but actually also on the consumer side, which it's a tricky problem if we have a price of zero.
Yes, absolutely. I think these are two very, very good point. There's a big conceptual difference between the individual level and the aggregate level, and do we really know at the individual level what our data are worth? Probably not. Let me put the last question to you that we got in the chat, which is that economists have had a hard time quantifying qualitative aspects of performance, worker morale, or so. And has big data gotten us any closer or any better at being able to quantify some such fluffy concepts that were underrepresented in many of our previous modelings?
I think one instance in which data has been helpful for things that are difficult to quantify is the use of textual analysis, right? So maybe we don't report a 7 of happiness each day, but maybe I send employees send out tweets, and that we can look at what kinds of language is being used in those. So I think that's one instance that's shown some promise of being able to measure previously unmeasurable in intangible or seemingly unquantifiable features of the economy.
Yeah, I tend to agree. I think there's probably some things you can measure that. I think the downside I see is obviously with the whole everyone working from home, and then this whole discussions about how much do we monitor, how much people spend on Teams, how many minutes a day they're away, or the discussions about can we use cameras to monitor when people sit at desks and so on. So I think there's a big downside to the whole monitoring of worker productivity using kind of a data-driven approach also, right? So I mean, people will if it's the number of clicks that you're counting, people will figure out a way to maximize the number of clicks that they do in a day or something. So I think the hard problem of what quality of output is actually will remain, and probably will remain also for a good reason.
Yes, very good, David. We are coming up to the end of the hour. Can I sort of pitch an open-ended question to both speakers, in the sense that going forward from your individual point of view as researchers, what's the next big thing in the economics of data? What to keep an eye out for, either research-wise or policy-wise? Is it the machine-to-machine data, or what is it? Maybe Laura first.
I'm in a finance department, so I'm going to go with data as an asset, and we're going to find new ways to trade it and to price it and to value it and to think about how its values fluctuate over the cycle and change with grow over time, or what I think that there's an enormous amount of financial value in there that can be unlocked if data could be traded more easily and put to its most efficient use. So I'm going to say data markets and data valuation.
Good one. I think there's a lot of positive things about the data economy. So in a way that I'm pretty sure the positives will be found out by some kind of canny entrepreneur. They're going to find out how to monetize this and that and everything. So I think in terms of research, I would like to see more probably on some of the downsides. So kind of in a business sense, I think data as a kind of entry barrier to competition. So I think that's a big one. That's what a lot of policymakers are interested in. That are we restricting innovation down the line if we kind of allow this data hoarding in a way? And then the second one is a bit like using data for the wrong purposes. So in a way that using data to target, I don't know, certain ads, for example, to vulnerable groups and so on, and kind of make use of the dark side of data. And I think we need more research on that as well.
Thank you very much, David. Any sort of final remarks that you would like to make? We got a final comment that I'm not quite sure what to make of, which is a question whether or not to rather avoid using labels, in particular political labels, in discussion. I hope we're not guilty of that one. We try to approach this from a sort of research economics of data angle, and clearly I think we have identified a number of issues. It's an NP hard problem. It's a really hard problem, I think, as Laura said. After a two-part series on the macroeconomics of data and the microeconomics of data, maybe we really need a regulatory governance webinar on data, because that webinar has identified a number of things. We need to think more about the various rationales of why we see zero price services. There are different rationales for it. There are different levels at which value to data emerges, and clearly there's a gap between the value of an individual data point and value if it is aggregated up. And maybe it takes certain proficiency to aggregate that up in a useful way. And there might be limits to how much we as consumers actually know what our own data, to the extent that they are personal data, are actually worth. So I think that webinar has produced a number of useful angles on knowledge gaps, where I think, but at least they are sort of more well defined than at the beginning of the webinar, where we need to think more deeply about how to go about it in the terms of its economic researchers, but then also I think ask the question, as both of you seem to be alluding to, is there a need for regulating that when it comes to remuneration, for instance, of data. Thank you very, very much for your time, Laura and David, and for your insights. Thank you to Susan and the Hub for putting on this event. I think it's really, really pertinent. Data and the economics of data is probably one of the most important things around at the moment, and I think it continues to do so for the foreseeable future. And thank you to the audience for your questions and for your attention. Stay safe and well, everyone, and goodbye.